Welcome to PhillipCapital's Weekly Market Watch. Equities markets across the globe have experienced a surge in volatility in recent weeks as renewed concerns about the insolvency of European nations such as Greece and Portugal resurface. Today, we speak with Mr. Melvin Ho, dealer from Phillip Securities, on this phenomenon and the implications for traders and investors. So Melvin, we often hear about the media describing the stock markets as being volatile. So how exactly should we interpret it?
When the market is quiet and moves in relatively smaller degrees of percentage changes, the market is characterized as experiencing low volatility. This usually represents a lack of fresh leads or news flows to interest prospective investors to enter or exit the market. When the market starts to make larger average percentage changes on a daily basis, the market can then be described as experiencing higher market volatility. Such higher market volatility is usually triggered by certain new leads or market rumors that may or may not be known to the public. Recent examples of such catalysts include the announcement of an unprecedented government bailout plan in early 2009 that led to a huge rally in the stock market, and the market plunge in the aftermath of Lehman's collapse in late 2008.
How has market volatility changed recently?
My studies have shown that market volatility across equity markets around the world in general have been on a steady downtrend since May 2009, which is about 12 months ago. This downtrend has, however, recently reversed upwards in the aftermath of news that Standard & Poor's has downgraded Greece and Portugal's debt ratings. This spike in volatility also coincided with some shocking plunges in equity asset prices, with the Dow Jones Industrial Average recording a 998 points plunge intraday. Although the Dow eventually closed about 348 points lower that same day, it was still the Dow's biggest drop in a single day for more than a year. Considering that for the past 1 year, we had a pretty smooth-sailing uptrending market, as well as the fact that the first 3 months of this year was relatively quiet, the recent sudden plunge in market prices was a significant change in the overall stock market's volatility.
What is the significance of this change in volatility for the stock market's direction?
I personally think the stock market's volatility is an expression of market participants' overall sentiment about future economic prospects. While market volatility is sometimes a result of unfounded irrational fears, not supported by true economic fundamentals, it can sometimes forewarn of a shift in the overall direction of the stock market. A word of caution for investors is that a previously trending market that has recently been moving in a choppy and directionless fashion without making much headway, and accompanied by spurts of increased volatility, but the STI in recent months may spell trouble in the form of a possible severe correction or a reversal. These were the characteristics of the 2007 bull market, which eventually ended in tatters, as well as that of the market bottom in 2009. Volatility is, however, only an indicator and not a reliable trading signal. Like all other indicators, we should read the market's price action to determine the market outlook.
Thank you, Melvin. That's all we have for you today. Tune in next week for more market updates.